As expected, the Fed held their target rate steady between 3.5% and 3.75%. I mean, this was a surprise to no one. During his press conference, Fed Chair Powell stated that they felt the upside risk to inflation and the downside risk to a weakening labor market had diminished to the point where they were comfortable staying put. And if you think about it, the past 3 meetings, they've cut 25 basis points at each meeting. And if you go back to September of 2024, they've cut 175 basis points. So they felt they put themselves in a good position where they can just let the economic data continue to roll in and they can sit pat. There really was no other major announcements. There was no updated summary of economic projections. There was no tinkering with the balance sheet. There was 2 dissents, but even the dissents were as expected. So relatively uneventful Fed meeting. There was no real surprises during this meeting. Like I said, it was relatively uneventful. Even the dissents were as expected. The thing that struck me most was Powell was asked about future rate cuts, as he always is, and his typical response is, "We've made no decisions at this point." However, he added on at the end, "But," and he emphasized "but," he did that on purpose, "we do think inflation has come down. We do think the labor market has stabilized, and we do see strong economic growth." So to me, the takeaway was he wouldn't expect to cut rates at March, and the market certainly isn't. The futures odds are significantly below 15% at this point. So that the only thing that stuck out to me was, again, he signaled to try and keep markets calm that don't expect any rate cut coming in March unless something drastically changes. From our perspective, we think financial professionals could benefit from staying active in fixed income, from being diversified and being flexible. I said the Fed meeting was relatively benign, but there is still uncertainty that exists at the Fed. We're about to get a new Fed chair, and we don't know the direction that he will take the committee, so uncertainty exists there. Rates are moving, but they're not moving uniformly. It's been steady for the past couple weeks, but if you go back a year, 2-year rates have come down 60 basis points, but 30-year rates have risen about 10 basis points. And that's really taken a lot of investors by surprise that rates aren't all moving in the same direction. Additionally, at the moment, credit spreads are tight, but we do see dispersion among sectors and in the index. And volatility will create opportunity. We've seen that. We saw that in April of last year. We saw it when the DeepSeek news broke. We saw it in August of 2024. There is opportunity despite tight credit spreads for an active manager. And finally, starting valuations are relatively attractive. If you look at the ag, it's around 4.5%. Investment grade corporates higher, and high yield certainly around 7% rather. And it all depends on your willingness and ability to take risk, but they are attractive. Cash rates have come down. There's been separation between cash and bonds. And if the Fed is to cut rates going forward, we would expect cash rates to come down further. So that kind of, to me, says, even though it was a kind of a boring meeting, we still think you have to be active, we still think you have to be flexible, and we still think you should be diversified in fixed income.